If you're a Canadian real estate investor or you're thinking about buying rental properties, you need to understand what's happening with OSFI's mortgage rules over the last couple of years. There's been a lot of confusion and misinformation floating around about these changes. So today, I want to walk you through exactly what these rules are, how they actually work, and what they mean for your ability to grow your portfolio. This is comprehensive information you can use to make informed decisions about your investing strategy going forward. So let's get into it. Let's first talk about OSFI, the Office of the Superintendent of Financial Institutions. They're the regulatory body that oversees Canada's banking system. Their job is to make sure that banks aren't taking on too much risk. Over the past few years, they've been watching real estate investors stack up mortgage after mortgage, often with high leverage and relatively little equity. So when interest rates were low, this strategy worked out okay. But OSFI started asking, what happens when rates go up significantly? What happens if rental income drops or vacancies increase? What happens if the economy slows down? So they decided the banking system was becoming too exposed to real estate investment risk. And so starting in 2023 and continuing through 2025 and early into 2026, they rolled out new rules designed to limit the over-leveraging and to protect the financial system. These rules don't make real estate investing impossible, but they do change how banks evaluate and approve mortgages for investment properties. OSFI introduced 4 major changes that directly affect real estate investors. Number 1 is how banks allocate your income across multiple mortgages. 2 is loan-to-income portfolio limits that the banks must now follow. Number 3 is classification systems for investment property mortgages. And number 4 is regulatory capital requirements that make these loans more expensive. Let me break down each one so you understand exactly how they work. Rule number 1 is the income allocation across mortgages. So this rule clarifies how banks have to treat your personal income when you're applying for multiple mortgages. It's technically been in place since 2023, but OSFI has been enforcing it more strictly more recently. So how it works is if you earn $150,000 per year and your first mortgage requires $50,000 annually to service the debt, you've only got $100,000 of qualifying income remaining. When you apply for a second mortgage, banks have to account for that already committed income. So you can't use the full 150 again as if the first mortgage didn't exist. Before this clarification, some banks were a little bit more lenient about this. They might look at your salary and qualify you for multiple mortgages without fully accounting for the debt service on your existing properties. So OSFI put the end to that. This significantly limits, of course, how many properties you can acquire using primarily your personal income. You can't leverage a high salary to continuously stack properties without considering the cumulative debt load. And this is where rental income becomes absolutely critical. If your properties can't generate enough cash flow to support themselves, A, they're not investment properties, they're tax write-offs. Your property should always be able to support themselves. But B, you're going to hit a wall pretty quickly on how many mortgages you can qualify for. The second rule is the 4.5x loan-to-income portfolio limit. So this is probably the most misunderstood rule, so I want to make sure you understand exactly how this works. OSFI introduced the 4.5x loan-to-income limit, but it's not what most people think. This is a portfolio level restriction on banks, not a hard cap on individual borrowers. So here's what OSFI actually told the banks. You need to limit how much of your new lending goes to borrowers who are borrowing more than 4.5x their annual income. So if you make $100,000 a year, that means 450 is at the 4x threshold. Banks can still lend you more than that, but the loans above that threshold count against their internal quota for what OSFI considers to be high-risk mortgages. So how are the banks handling that? Each bank sets its limits on what percentage of their new mortgage lending can exceed this 4.5x ratio. Once they start approaching that limit, they become much more selective about who gets these larger loans. So if you're applying for a mortgage that would put you above your 4.5x annual income, you're not automatically rejected, but you will face more scrutiny on your application. You'll probably pay higher interest rates. You'll require more documentation to support the property application, and you'll possibly have to put down a larger down payment. The bank can still approve you. They just need to be strategic about how many of these loans they issue because they're working within OSFI's portfolio limits. This makes it harder to scale a portfolio quickly using high leverage. The higher your loan to income ratio gets, the fewer banks are going to compete for your business, and the more likely it is that you're going to pay higher interest rates and fees. Rule number 3 is the income producing residential real estate classification. A nice, quick, easy, simple name like bureaucrats like to create. OSFI created a new classification system that affects how banks treat mortgages for investment properties. This gets technical, but it's important to understand because it does impact your costs. If more than 50% of your mortgage payment comes from rental income, which it should, rather than your personal employment income, the loan gets classified as income producing residential real estate, or IPRRE for short. So why does this classification matter? Because IPRRE mortgages are treated as high-risk loans by the banking system. From a regulatory perspective, rental income is considered less stable than employment income, which I find ironic, because tenants can leave, properties can sit vacant, and rental markets can shift. Now, if you're a sophisticated investor, those things aren't really high risk. When a mortgage gets the IPRRE label, banks must hold more regulatory capital against it, and I'll get into regulatory capital in a minute. The point is that this classification makes the loan more expensive for the bank to carry. OSFI did not mandate specific rules on how much rental income banks can count when qualifying borrowers, but each bank still sets its own underwriting standards. But because IPRRE loans now require more regulatory capital, banks have generally become more conservative in how they evaluate that rental income. Many banks will apply what they call a haircut to the percentage of gross rental income when calculating your qualifying income. Most lenders have been doing this all along, but now they may increase or decrease, I should say, that percentage of rental income that they count toward the property. So some banks might count 80% of rental income, some might count 50%. The average has been between 50% and 70% that most lenders will count. So for example, a lender will count 50% of their rental income towards the debt service of that property because they're assuming that the property potentially could be empty 50% of the time. So some banks may count a higher percentage, but then subtract estimated vacancy and maintenance costs. These policies are varied by lender and they're not mandated by the OSFI. So let's say you're buying a property that generates $3,000 a month. Okay. A few years ago, a bank might have counted $2,700 of that monthly rent when calculating whether you can qualify for the mortgage. Today, that same bank may only count $1,800 or $2,000. Same property, same rental income, but now you need more personal income or a larger down payment to qualify for the same mortgage amount. OSFI didn't create mandatory haircut percentages, but by making these loans more expensive for the banks to carry through higher capital requirements, they indirectly pushed banks to be more conservative with how they evaluate and count rental income. I keep mentioning regulatory capital. So let me explain what that actually means, because it's the foundation of why all these changes matter. Regulatory capital is the amount of money that banks have to keep in reserve in cash instead of lending it out. It's their safety buffer. For every loan that a bank makes, regulators require them to set aside a certain percentage of their own capital as protection in case that loan goes bad. It's like an emergency fund. For a standard lower risk loan, they might need maybe a 5% to 10% reserve, 5%, let's say. For a riskier loan, they might need to double that to 10 or 15%, maybe even more. So when OSFI requires more regulatory capital for investment property loans, banks have less money available to lend elsewhere. They're tying up more of their capital in reserve, which means they're earning less on their overall lending portfolio. Poor fellas, they're barely scraping by, and they have to keep all this money in reserve instead of lending it out. To compensate for this, they charge a higher interest rate on their loans, and they require more regulatory capital. So when OSFI classified investment properties as requiring this higher regulatory capital, it automatically made these loans more expensive for the banks to offer. And that cost gets passed on to you as the borrower through higher interest rates or stricter qualification requirements. This regulatory capital requirement is the underlying mechanism behind almost everything we've talked about today. The rules didn't ban investment property lending, they just made it more expensive and more restricted at the bank level. So what does this mean for your investing strategy? Let me bring this all together and talk about the practical impact on your ability to build a real estate portfolio. OSFI's rules fundamentally changed how banks evaluate risk for investment property lending. Your income can't be recycled across unlimited mortgages anymore. And banks face portfolio constraints on high loan-to-income lending. Investment properties require more regulatory capital, making them more expensive to finance. And banks are more conservative about rental income than they were before. The strategy of acquiring 5 properties in 2 years with small down payments, that's off the table for now. What you need to focus on if you're going to move forward investing in real estate is each property should be qualifying based on its own income ability. If you're looking at buying investment property, the cash flow from that property should be able to pay for itself and more. I would suggest you look at properties that provide a DCR of at least 1.25x. You can't continue to subsidize weak cash flow properties with your personal income. That's, like I said before, that's not an investment property, that's a tax write-off. Large down payments make everything easier, but obviously not everybody is available to do that. So you may need to look now more at getting joint venture partners or getting private lending investment. Expect higher interest rates on your investment properties. The days of getting the same rate on your rental properties you got on your primary residence, those are long over. The more properties you currently own, the harder it becomes to add another one. Each mortgage compounds the difficulty of qualifying for the next. Now, historically, you'd probably hit that wall with lenders right around the 3 to 5 property mark if you were qualifying on your own anyway. So that may have been now reduced based on your income and your ability to qualify. Strong documented rental income, that's critical, like I said. Properties that generate solid cash flow will qualify obviously much easier than properties with tight margins. As investors, we need to understand the rules and adapt our strategies accordingly, because that's the difference between a sophisticated investor and someone who's just kicking tires. Is can you take these new rules now, adapt them, and continue to build your portfolio? So real estate investing, it's still one of the best wealth building strategies available to us in Canada. But the environment has changed, and you need to understand these rules so you can make informed decisions about how to structure your deals and grow your portfolio. Money in real estate is made when you buy the property. That principle hasn't changed. What has changed is how much you can borrow and what you're going to pay for that financing. If you found this information valuable, hit the like button, subscribe to the channel. I create content specifically for Canadian real estate investors, covering everything from deal analysis to property management systems. And I would love to get your feedback if you've experienced any of these lending changes firsthand. Drop a comment in below and let me know. Thanks for watching. I'll see you in the next video.